Hello, Arkansas, and welcome to this week's edition of Arkansas Money Talk, brought to you by the team of Retire Path Wealth. I'm your host, Kristen Oakley, and joining me in the studio, we have the president of Wealth Management, Dale Colclaser, and Mark Smalling, who is the co-founder. Today's show is called Ready, Set, Retire, and if you have wanted to know what you can do at what point in your retirement journey to make sure that you are prepared, you don't want to miss today's show. Dale and Mark, it's great to be back with you. How are you this week?
Wonderful, wonderful.
Doing great. It's always good to be here.
Well, great. Well, I'm excited to have this conversation with you all because a few weeks back we did a show called Mark Your Calendars. It was all about big birthdays in retirement planning. You guys got such a great response. A lot of folks called into the show, came in to meet with you, and they were saying how helpful it was just to know what to do when, because I think it can be really overwhelming for a lot of people. And retirement planning, the thing is, it's never too early to get started. There's so many key dates and ages where you can take proactive action to really set yourself up for success in retirement. And as a result, you all have created a really helpful resource that we're going to be sharing with our viewers today. So let's get to it, shall we?
Oh, absolutely.
Awesome. All right. Well, first up, we have a retirement survey that came out in 2023, and it found out, this was Schroeder's U.S. Retirement Survey. They surveyed 2,000 investors nationwide and found out that 49% said that they do not have a retirement income strategy. 57% of people are concerned about not having a regular paycheck in retirement, and 23% said that they were terrified. And gosh, that's heartbreaking, because this is what you do day in and day out for folks. You're able to alleviate this fear and these concerns. So let's start off. When do you recommend that folks first start planning for their retirement?
Well, Kristen, I'll back up just a tad, and let's talk about that. I think is what we've learned over the years is we fear, as human beings, we fear the unknown. Sometimes we even fear more knowing the unknown, if that makes sense, is knowing what those outcomes can be, because we don't believe they can be positive in so many cases.
Yep.
So there's never really a too early of a time. And again, the resource we've created, we'll talk about today, really starts at age 50, because I think that's about the time that most people have the propensity to get serious about what they're really doing. There's a lot of really motivated people out there that are going to start very early and begin saving, but they're really not constructing a great idea of what they're doing, probably until a little later in age.
Sometimes it's hard to see retirement if you're too young, and so so we do see, 50 is that time when people go, oh, it's there. I can see it.
It's time to get serious
it's
about
time
it,
to get
right?
Serious.
That's right.
Well, how would you, I mean, how important it is to have all these different components, because one of them is enhanced planning that you guys talk
That's
about.
right.
You know, how important is it to have that in place as well?
Well, it's very important, because I think so many times when we talk about the concept of financial planning, which is one of the reasons we like to use terminology, our process is a written income plan, is because so many times the term retirement plan gets confused with the fact that I have a 401k. Oh, I have a retirement plan. That's going to take care of everything. I just got to put some money in there and then everything's going to be all right. Or the reality of it is I need to be able to address not just investments, because that's really the only thing that's taken care of, but I need to address income planning. I need to address tax planning, health care planning, and then of course estate and enhanced planning. We like to utilize the term enhanced planning as opposed to just estate in itself, because there's so many other things besides just having a will or a trust in place, whether that be to make sure we have our beneficiaries updated. I can't tell you how many times we've had someone come in, even just recently, we had a client that came in that had an account that she'd opened in her 20s, and she's already into a whole nother stage of life, about ready to retire, and she'd never updated the beneficiary from her mother and father when she opened her original IRA account that was still in her maiden name.
Right, and that's so common. I hear stories of that all the time.
Right.
It absolutely, I mean, we see it almost every day, and it doesn't matter who you are. We see it across the spectrum, and it's really important, whatever age you are, to review all of those things and make sure that those are properly
that they're up to date and say exactly what you want
that's
them
exactly
to say,
right.
Not only that, the other thing I want to bring up too that I think most commonly gets overlooked is that we assume that enhanced or estate planning is for the end of life. And it's really not. If you have assets of any amount and you have minor children, having a proper estate plan is probably even more important at that time.
Yep.
If something were to happen, if you're a single parent, to yourself or to both parents.
Yeah, for sure. Well, I want to go back to one other thing you said, Dale, too, where you were talking about how a lot of folks think, oh, I have a retirement account. I have a 401k,
Oh, yeah.
a 403b, an IRA, and I just hope that I've saved enough, and then hopefully it'll last me the rest of my life. We always say that those are retirement accounts. They're not retirement plans. That's the difference. You know, you can't bring in your pile of statements and be like, here's my plan, right? It's what you do with all the different components that make up the financial plan. It's much more comprehensive.
It is, and that's what we see when people come in the office is, you know, people have things kind of scattered in a hodgepodge of different investments, and it really is trying to pull everything together because, you know, most people don't stay at the same employer for their whole working life. They have multiple accounts, multiple 401ks or IRAs scattered in different places. And what do we do with all of that?
Right.
How do we pull it all together?
Well, you mentioned that age 50 is a key date where a lot of folks wake up and go, okay, it's time for me to really start thinking through this. What are some key dates in the decade of the 50s, and what do folks need to be preparing for when they hit that big birthday?
Well, the major one, and we'll just start chronologically with that, is at age 50, you get enhanced contribution options. So if I'm one that's out there maximizing my contributions, or even more importantly, if you haven't started, here's a chance to really get after it because those amounts on an IRA change from $7,000 to $8,000. In a qualified plan, we go from roughly $23,000 to $30,500. That's also a great opportunity for people to begin to diversify if you have Roth options or after-tax options in your employer-sponsored plan to begin to diversify in your tax strategy as well at that point with some of those enhanced contributions, because when you're making contributions of that level, you really are affecting your current tax situation. So let's make sure we're making the best effect on what our future tax situation looks like as well.
Right, for sure.
And then another date is age 55, because you have a lot of people that retire early. They may have, there still are people out there that have pensions. And so if you retire in the year of age 55 or later, then and you have an employer plan that's active from where you retired, you can actually start pulling out income from those plans without any penalties at 55 or later.
Right.
And that's before we get to...
Right, that one's a little more particular before we get to the 59 and a half. Sorry to jump the gun there. But 59 and a half is the big one where most plans, and again, got to check your plan document to see because that is up to the plan provider, to be able to make what they call in-service distributions, where I can literally take money out of a plan that, if it's my contribution, and in most cases, to begin to diversify outside. So if I have been with one employer, all of my money is tied to that employer's plan, I'm looking for more options. I'm looking for other things to secure some income, which is really common these days now that interest rates have improved. And as Mark mentioned, a lot of people don't have pensions. We're looking for some more secure income. That's a way to be able to pull money out of a qualified plan, get other options put in place that may need time to grow, to add some guaranteed income to my situation. That's a great opportunity for those.
And it's so interesting that there are these half birthdays that are so critical to retirement plan. And we've talked before how a lot of times people don't realize, oh, it's a half birthday that's a big deal, right?
And it really is the 6 months that makes the difference, because that plan's not, it's going to know your birthday, and it's not going to let you do it until you hit that half.
Yep, for sure. Well, this is why we want to highlight this incredible resource that you all created for your clients. So can you talk a little bit about that and how our viewers can get a copy today?
Yeah, Kristen, I'm going to try to hold this up so everybody can see it, but we call this my retirement calendar, and it's really kind of more of a checklist just to kind of step through the ages of things that I can look at. And if you're curious out there today of what options are available to me now, what windows may have I already missed, but I know other people that are going to be stepping through those same age categories, or I'm looking at what I need to focus on in the future, kind of building my retired path. Again, we're going to play on that name back there, but that's why we put that in place. But if those are things that you'd be interested in learning more information about, please give us a call today. Happy to sit down with you, explain how those steps can work in your personal situation to let you know what benefit and value can come by adding a financial advisor to your situation.
Wonderful. Dale, Mark, thank you so much. I know we have a lot more to get into on today's show, but here's the reality. We don't want you to be like those people surveyed who are terrified, who don't have a plan in place, who don't know how they're going to be able to achieve a successful retirement income. You can alleviate all that stress by receiving your very own complimentary written income plan from Dale and Mark and the team at Retire Path Wealth. To claim yours, all you need to do is call 866-724-3893 and schedule a time to come in. This is for no cost, no charge, no obligation. It's simply an invitation to have a conversation to see how the team of Retire Path Wealth can help and serve you. If you'd rather not talk to someone right now, but you do have your smartphone handy, you can also connect this way. Simply pull it out. If you open up that camera app, you can point, click, and scan that QR code that you see there down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team will reach out to connect with you to schedule your complimentary visit that way as well. And I know that Dale and Mark are looking forward to meeting with you, and when you come in, you're also going to be able to receive your own copy of your very own retirement calendar. More when we come back on Arkansas Money Talk.
I became a financial advisor through a referral from my financial advisor. I was leaving a career in the corporate world and basically was looking for something else to do. And he said, "Hey, don't you have a finance degree that maybe you can put to good use?" I went to college, was supposed to be a dentist, and physics and organic chemistry changed that path. I think it was the realization of of having worked somewhere long enough to know that I didn't want to have to work for someone else, that I was looking for more an entrepreneurial career path, and the opportunity for financial planning offered that, to where I could basically have my own practice at that time. Started one of the biggest financial planning firms out there. There was a lot of positives learned from there, but also learned a lot of things that didn't really line up with my sense of belief, and knew that there were others out there that probably felt exactly the same way. So even though I learned a lot about the industry, I also began to learn that a lot of financial advisors are taught the industry by the vendors and wholesalers themselves, and came to the understanding that a lot of what we consider to be general consensus advice is really based on those techniques that are benefiting those that are teaching, not necessarily those that are investing in those products.
Welcome back, Arkansas. You're watching Arkansas Money Talk, brought to you by the team of Retire Path Wealth. I'm your host, Kristen Oakley, here with both Dale Colclasure and Mark Smalling, and we are talking today about important dates, key birthdays you need to be aware of as it relates to your retirement planning. And we covered the decade of the 50s in the last segment. It's time to transition now to the decade of our 60s. And my gosh, this is a huge decade for retirement planning, isn't it?
Oh, yeah. Yeah,
It really is.
When you got to get after it.
Yeah, for sure.
Yeah, so when people start getting in their 60s, and I mean, you start seeing people that are asking more about long-term care issues, and oftentimes that's because they're dealing with those issues with their family members, and they don't want their family to have to deal with the same things that they're dealing with their parents. Right. And so that's when you start having more of those conversations.
Right.
You know, and
about
Kristen, and it's great that we have a lot more options available today. So, because I know a lot of people have looked into traditional long-term care and understand the expense of the premiums, and they're like, gosh, I just can't see this. But they're also, as Mark's mentioned, they're dealing with their parents. So they're trying to figure out how to preserve the parents' wealth. They're trying to figure out how to still accumulate the wealth that they need. They're seeing possibly inheritance that they had anticipated now possibly going to dissipate, and then they don't want their kids to go through the same issue.
Right.
And that's a great time to begin addressing that issue, because there's lots of available options today, whether they be through the traditional method, through special life insurance, or even asset-based plans that are out there now. That can be some really great options to offset those costs that they're anticipating coming because of long-term care.
And I love that the team of Retire Path Wealth, because you are independent, because you are comprehensive, holistic, fiduciary financial planners, you're able to incorporate that piece. That is such a crucial piece of someone's overall financial plan. I think that's what really stresses a lot of people out, is not knowing how much money they're going to need to spend on health care, long-term care, but you're able to build a plan that accounts for that.
Well, and so many times that they go and they ask the person that they're calling their financial advisor, which is just such a loose term these days, and they're asking them those questions. He goes, nah, that's not something we deal with, but hey, we can refer you to someone else who, again, as you mentioned, may not have much knowledge about the rest of their situation.
Right, yep. Well, moving on in the decade of the 60s, we have to talk about the next huge subject that starts at age 62, which is?
Social Security. Yeah, so that's, we get more calls about that than probably just about anything else. At 62 is when you can first start taking your Social Security benefits based on your retirement income, but if you take it at 62, you're going to be taking it at a reduced amount, somewhere between 25 and 30% less than what your full retirement age is. There's a lot of considerations to be taken before you decide to take it. Are you still working? Because if you're still working, there are earnings tests that will determine whether or not that benefit is reduced. The other thing is, do you have a spouse that's dependent on your Social Security benefit, or would be even more so after you're gone, because that reduced amount is going to follow them as well. And so that's really an important consideration.
Yeah. So you said a lot of really good gems there that I think we just need to make sure our viewers caught. One is that if you are still working, you could be subject to something called givebacks, right? And you would have to give back some of your Social Security benefit if you earn too much money. A lot of people aren't aware of that.
That's correct.
You also have to look at the taxation of Social Security, right? A lot of folks aren't aware that up to 85% of your benefit could be taxed. And do you find that a lot of folks just haven't done the proper planning to account for either of those things coming into play?
No, because the natural sense is more money is always better. And so the more cash flow I have, because the honest answer is with income planning, this is all about cash flow.
Right.
And so they just think the more cash flow that comes in, the better off I'm going to be, because what the common statement is, oh, I'll just save it. Well, great. But if we're only receiving 65 to 70% of those dollars, because the rest of it's going to taxes, it might be better to save it in that account that's going to be guaranteed to grow at 6 or 8% as we move forward, and take that later when we're not having potentially as much of a tax hit on those dollars as well.
Yeah. And then, Mark, you brought up a really valid point, too, that it's so important for couples to engage in Social Security planning, because when one spouse passes away, you only get to keep one of the Social Security checks. Now, the good news is you get to keep the higher of the two checks, but to your point, determining when you're going to file and claim your Social Security obviously directly impacts how much you're going to receive, and that could have consequences down the road when there's only one spouse left standing.
Yeah, that's true, and that's where we see, with older individuals, that's what's happened is they took their benefit early, or their spouse took their benefit early, and it causes a retirement income problem later on in life, and that's one of the biggest determinations of that. And in most cases, that's what's happened.
Well, because when people do that break-even math calculation that I've heard everybody, well, I've already done the math.
Yeah.
Well, what you didn't do was the depreciation of your benefit when it passes to your spouse, because you both chose to take it early. You didn't do that. Net present value backwards calculation on there. So your math's incorrect, or it's at least incomplete.
Yeah. Well, when folks do come in to meet with you, talk a little bit about what they're going to be able to receive from a Social Security standpoint, because I know you all run reports and are able to do the analysis for folks, right?
Right. We do a Social Security maximization report where it actually takes their situation based on what they have as far as other retirement sources and income, maybe pensions, and we help determine what's the best time for them to take their Social Security benefit, not just anyone else, because it's not a generalized thing. It's very specific to each person's situation.
Yep.
And then we start getting to later on in the 60s, we get to 65, Medicare's available.
Yes,
that's another thing that
it's a huge birthday, right?
It's a huge birthday, and people are confused about what to do. And there's a lot of people that are out there that are still working at age 65. They're still on an employer plan. What's best? Is it best to stay on the employer plan? Is it best to go on Medicare? Don't know what to do? That's something else that we help people with in our office. We help them determine whether or not that's a good way for them to go.
Yeah.
Well, and the other is, Kristen, we're going to mention again the whole independent deal. We're carrier agnostic as to when it comes to those type of plans as well, by just simply finding the best option that fits with you, where we're not restricted to one carrier, because so many people just assume, hey, Medicare is always going to be less expensive. But the reality of it is, if you're on an employer-sponsored plan, that's probably not the case.
Or if you're still working and your income's over certain levels, you're going to have what are called income-related Medicare adjustment amounts, which cause your Part B premiums and Part D premiums to cost you more.
Yeah,
So
and not to get into the weeds of that, but there's a 2-year look back. So
It's
how
all- yeah.
it's all tied together. I mean, we say this all the time, almost every week, right? How you make a decision in one area of your financial life can and will affect all the others.
Right.
Well, I know we need to wrap up this segment, and we're talking about decade of our 60s. Talk a little bit about the full retirement age, because I think that's a key thing for folks to understand as well.
Right, and full retirement age, for most people going forward, if you were born 1960 or later, it's going to be 67. If you're born before that, it's going to be somewhere between 66 and 67, depending on what year you were born in. But for most people that are out there today, 67 is probably your full retirement age. That's when you receive your full retirement benefit without any reductions for taking it early.
Right. Well, remind folks what they're going to be able to receive today by calling in to not only get on your calendar and meet with you about their individual situation, but this awesome resource that you're giving away.
Right, yeah. I mean, I'm going to try to hold this thing up level here so you can kind of get a good look at that. But the idea, too, is in addition to just being able to set up that initial appointment to get your Retire Path process started, to find out what value we may be able to add to your situation, we're going to hand out this free guide that's going to help you put together a checklist of dates that you need to make sure to check off, where maybe it's not I'm actually going to start something, but I need to at least begin to consider the aspects of what's available coming forward.
Yeah, absolutely. Well, I'm excited to continue. I know we got to get into the decade of our 70s too, but this is a great opportunity as we take this quick break for you to call and receive your complimentary written income plan and your very own My Retirement Calendar from the team of Retire Path Wealth. Again, this is completely complimentary. All you need to do is call 866-724-3893, or you're also welcome to scan that QR code and that will get you connected as well. More when we come back right after this.
A retirement income planner isn't just a professional resource. They are your advocate, your strategist, and your guide on a journey to a successful retirement. At Retire Path Wealth, we work with families just like yours to customize strategies based on your unique goals, your risk tolerance, and your life stage to ensure your retirement plan aligns with your aspirations. Hi, I'm Dale Callclaser, Certified Financial Planner. If you are searching for a fulfilling retirement and confidence in your financial future, give us a call and learn more about how we can help.
Welcome back to Arkansas Money Talk, where today we are talking about Ready, Set, Retire, what you need to know when to do what as it relates to your retirement planning. And I'm so excited, Dale and Mark, that you guys have created this awesome resource called My Retirement Calendar, which of course you're offering when folks call in and then come in and meet with you. Let's move on to the decade of our 70s, because again, there's some key dates, some key birthdays. There's been a lot of confusion because some of the rules have changed. So let's dive into some key dates that folks need to be aware of.
Yeah, well, 70 itself is a time when, if you haven't already taken your Social Security retirement benefits, it's the latest date that you can actually defer those to. So if you've waited past your full retirement age, you've earned what are called delayed retirement credits of 8% a year from the time of your full retirement age till you get to age 70. And then at that point, there is no more growth on your Social Security. You might as well take it.
Right, so there's no point in waiting beyond age 70.
Nope.
Right.
Nope. And then obviously at 70 and a half was the original date for required minimum distributions. Now that, because of Secure Act and Secure Act 2.0, have been moved to 73 and 75, which we'll touch on. But the one thing that didn't change was the ability to be able to take qualified charitable distributions, and I know this is something we harp on all the time because it's something everybody should be taking advantage of that makes charitable contributions, because now of our standard or our higher standard deduction, a lot of people aren't able to get a tax benefit. Now we know that's not why you make those charitable distributions,
right,
but we have to learn to work within tax code.
Right.
And it gives us this opportunity to circumvent our situation by having that plan in place. And so many people think that deferred back to the 73 and 75. In reality, that's not the case. So at 70 and a half, we could begin to start those. If you're already have met an RMD eligible age, obviously you're already having to take those distributions. But for a large number of people, we're now currently at age 73 and then going to move to 75. RMDs are one of those things that are very commonly misunderstood, obviously. Maybe secondary to Social Security and Medicare benefits, which again, we're all in that age. And the reality of it is sometimes we're a little less confident in making decisions for ourselves when we get into our 70s, that maybe the information we have is not complete.
Right. Yep. And with those required minimum distributions, we could do a whole show just on those alone. There's so many ways those calculations can get, misconstrued or done improperly. But this is something that you do for folks day in, day out, is you help make sure that those calculations are done correctly. Because if not, guess what? The IRS will hit you with an additional 25% penalty. And we don't want you to be, at fault and have those penalties unnecessarily.
Right. One of the most commonly misunderstood things, too, when we go back to the QCD is, a lot of people, think, oh, gosh, I'll just handle this myself and I'll leave it in my 401k plan because I've heard, oh, they have lower expenses, they have this, these are the benefits. And the reality is you can do that. But the challenge is you cannot make that qualified charitable distribution directly from your employer plan. You can only do that through an IRA. So if those are options and opportunities, and again, some of the old rules haven't changed from other options, that even though QCDs are not required on a Roth 403b or 401k plan, we have a particular plan that we work with that has not updated those rules. They're still going to send out that distribution from your Roth option every year if you're meeting these ages, and that many cases is not to your advantage.
Right. Well, I'm curious because obviously the RMD age, is now 73. It's going to be 75 for people in my shoes,
yes,
right, later on. But how early should someone start planning for these? Because there's a lot that can be done from a tax planning perspective way ahead of reaching RMD age, right?
Well, I mean, literally the idea, we probably back that all the way up to 59 and a half. When I have the ability to begin to withdraw money, or maybe the 55 if I'm drawing it from my own employer-sponsored plan, is to begin that planning process back earlier, especially now that we have this window that may be possibly closing due to tax code changes coming in 2026.
Yeah. For sure. Well, gosh, I know we only have about a minute left in the show. What would you want to leave viewers with who maybe have felt a little overwhelmed in the past and really are looking for that roadmap to know what to do when so that they can be ready to get retired when they want to?
Well, if you are listening to us today and we're going through this calendar and some of these things are actually concerning to you because you hadn't thought about them before, we want to offer to you to come into our office, meet with us. We'd love to talk about your situation and help you develop a plan for your retirement where we address all these different ages and all of these different hurdles that you're going to come upon as you come into retirement.
What I know, so many folks have called from the previous show where we touched on a lot of these things. I know you're looking forward to connecting with more folks.
Oh, absolutely.
Yes, for sure.
Yep.
Well, Dale, Mark, thank you so much for being here, and thank you for creating this very helpful resource. And if you would like to get your hands on your very own My Retirement Calendar and also receive a time to receive your complimentary written income plan, again, call 866-724-3893. We love you, Arkansas. We look forward to being back with you here at Arkansas Money Talk.